Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. This week, it's going to be all about the Fed. Why is that? Well, next Wednesday, we have the September Fed meeting, which is widely expected to be the first rate cut since the Fed rate hike cycle began back in March of 2022. So the last economic report, the big one, if you will, US core CPI rises slightly more expected. Let's discuss the implications of that data on the Fed's decision next week. That Fed rate cut is coming next week. So 25, 50 basis points, both are in play right now. And let's talk long term. We're at 5.5% upper bound Fed funds rate. Where do we expect, and where does the Fed explicitly tell us that they expect the long-term Fed funds rate to land? Perhaps not until 2026. So let's take a look at this chart. This is the month-over-month change of the US core CPI that increased at 0.3%. Why is that important? Well, you can see there, that's the highest that we've experienced since April and much higher than the past 3 months. If you look at the past 3 months, we're still running at that annualized rate of 2%, but this was slightly higher than expected. Just a reminder that core CPI strips out both food and energy, which are the more volatile parts of the inflation report, and focuses on those core goods and services that are primarily driving the longer term trend, and it kind of smooths that out. So on one side of the coin, you have the month over month pickup, the highest that we've seen in the past 4 months, higher than expected at 0.3%. That could cause some members of the Fed committee to say, hey, there's some signs that pockets of the economy, most notably housing and transportation services during this month, have picked up a little bit. Let's hold off on that 50 basis point cut. While others are going to argue, hey, that 50 basis point cut is still in play. Over the past 3 months, we've had annualized inflation of 2% by the CPI, core CPI. If you look at the PCE, 3-month annualized at 1.7%, that's more of the Fed's preferred measure. So there's really arguments on both sides. I think it's going to be interesting to look at the committee minutes and look at the voting members. I think there's going to be some discrepancy between those. Right now, I'm probably leaning toward that 25 basis point cut as we get closer. If you look at the Fed funds futures probability, these things are going all over the place. Before some of these reports, I was probably more leaning toward 50 basis point cut. But if you look coming into the end of this week, and this could change by Wednesday, I think what we've seen historically as we get closer, these start to get locked in. But this is one of the more interesting Fed meetings where there's still some debate, just 3 to 4 trading days until that Fed decision. You can see a 55% probability of a 1 basis point cut, moving that upper bound from 5.5 down to 5.25%. And a 45% probability that they're going to take that 50 basis point cut, try to make that big step down to get towards that longer term Fed's target rate of around 3% that we're going to talk about at the next chart. Some arguments on both sides. If you look at the 50 basis point cut, there's some discussion about, hey, that may cause the Fed to sound the alarms that they're concerned about the economy. Others are arguing that, hey, the 3-month annualized PCE is running at 1.7. The 3-month annualized CPI is running at 2%. That's at or below the Fed's long-term target for inflation. You have the unemployment rate that's ticked up above 4% the past several months after that lengthy record streak, the highest streak since the 1960s of unemployment rate being below 4%. Labor market's showing concern. The past 3 months, inflation's running at or below the inflationary target. Why are you waiting with the 5.5% to cut little baby steps of 25 basis points when you're so restrictive right now? I think there's a decent argument there that I kind of curry favor to, but I think the 25 basis point cut is probably the safe play right now, especially with that core CPI. I think you're going to see some members maybe do that, but I think in the next few days, it's going to be interesting to see what it ultimately is. But regardless, that Fed cut is definitely coming next Wednesday, and Powell has been pretty transparent about that. So where are we going longer term? Every quarter, the Fed puts out a summary of economic projections. It's basically a report, a PDF they print on their website. Everybody takes a look at it. The dot plot's in there, which some of you might have heard. That basically just says where they think the Fed funds rate is going to be year end of the next few years. They also put out summaries of expectations for inflation, for GDP, and other economic data. Well, this is the long run FOMC summary of economic projections for the Fed funds rate, the median, right? They all have a bunch of voting members, so not everybody's going to vote the exact same, but this is the median right there in the middle. You can see it's just above 3%. And based on these projections, that's the long-term sort of neutral point where the Fed doesn't view that as restrictive or accommodative. So about 1% north of that 2% inflation rate, 2% target inflation rate. So if you look at that from 5.5 all the way down to 3%, you're not looking at reaching that target until 2026 if we're just kind of doing these baby steps, 25, maybe a couple 50 basis point cuts over the next year and a half. The only way to get there anytime soon is doing those 50 basis point cuts. If we see sort of the soft landing occur, we may not see that 3% until early 2026. If we see some sort of an economic contraction and the Fed is behind the curve, and that's really up for debate. Economic data is not showing it right now, but sometimes economic data comes at us fast. Right now, we have seen some weakness in the labor market, but we have seen the economy, especially the economic data, be pretty resilient overall. But I think the Fed's in the right path here, cutting that rate. 25 or 50 probably doesn't matter right now, but I think the speed at which they do it over the next 3 to 6 months could be important for the economy with a long-term goal of 3%. We're going to get there faster if we have a contraction. We're going to get there slower if we achieve that soft landing that the Fed historically has had a challenge doing. So Boeing, always in the news for all the wrong reasons, it seems like in the past, right? They've had all of those issues with quality control and some of the issues with jets of bolts flying off windows and all types of stuff. Really a lot of trouble for the leadership there. Well, it's not getting any easier. More than 30,000 Boeing workers walked off the job early Friday of last week after staff rejected a new labor contract approved a strike with a 96% vote. This is one of the largest remaining unions in the United States. This is going to delay the 737 MAX, one of their big flagship airplanes, that delay the production of that. So just another eyesore on the Boeing company. They cannot seem to get out of their own way. So hopefully they can resolve that for the Boeing shareholders and those employees pretty soon. But another bout of bad news for the leadership of Boeing. With that, I want to thank everyone for watching, and I'll see you next time.